Hey everyone, my name is Ryan and welcome back to my channel where I'll be sharing with you different topics on personal finance. Now today what I want to talk about is, as a first-time home buyer, what are some of the biggest traps that we need to avoid and how can we make our home purchase as smooth as possible? Because buying a property is probably one of the biggest decisions we can make in our lives. And even though the process may seem complicated or overwhelming, it really doesn't have to be as long as you know what to watch out for. So let's get right into it. Now the first big trap we need to watch out for is putting all your down payment money into a savings account. Because this may seem like a good idea at first, but oftentimes people actually overlook the benefits of using something that's more tax efficient, like the RRSP and TFSA. For example, the RRSP can give you a huge amount of tax savings, and depending on your tax rate, you can get back on average 20 to 30% of how much you put in as a tax refund. So you can imagine this can really speed up your down payment saving process. And when you're ready to buy the property, you can also withdraw up to $35,000 out from your RRSP tax-free to purchase your first home. Also, most bank savings accounts, they offer little to no interest. So while it takes us a couple years to save up enough for a down payment, it's usually a good idea to invest and grow our money so that we can reach our goals sooner. And within these RRSP and TFSA accounts, you can actually choose different types of investment, right? You can choose something that's more conservative, or you can choose something that's more aggressive, depending on your comfort with investing, and also the timeline for when you're gonna buy the property. And when you're investing, RRSP and TFSA are actually great tools to use because inside the account, when you have any gains from your investments, it's actually not gonna be taxed. Now, when using these accounts, there are more details that you need to pay attention to, but most people already know about these accounts quite well, so I'm not going to repeat it here. But if you do want to learn more, I have explained it in more detail in a previous video, so I'll leave a link here or I'll leave it in the description below so you can check it out. Now the second biggest trap you want to watch out for is looking for a house before doing a mortgage pre-approval. Most people, when they save up a good chunk of money, then what they'll do is they'll start shopping around for houses. Now that might not be a bad idea to start looking around online, looking at what are some of the things that you want or need and creating a list of like some of the criteria that you have for a house. But before you go talk to a realtor or go into different open houses, there's actually one extra step that you should do, and that is the mortgage pre-approval. Because what this does is it'll tell you whether or not you can qualify for a loan, right? Because what's the point of shopping around for a house if you cannot get a mortgage at the end? And more importantly, by doing this, you can actually figure out what is the maximum budget for your house, right? Because they will tell you what's the maximum amount that you can approve for, and from that, it will actually create a ceiling for yourself in terms of what are the houses and what's the maximum purchase price that I should be looking out for. And if you've done this step before shopping for a home, then you'll never run into the situation where you see a home that you really like, costs $700,000, but you can only get approved for $600,000, right? So at the end, you can't actually buy it, right? You'll be left disappointed. And when it comes to doing this mortgage pre-approval, there's actually three main types of lenders that you can do it with. The first type is the mortgage broker. And a mortgage broker is a licensed professional that basically acts as the middle person who will help you shop around, right? Negotiate and find the best deals out there. Generally, they have access to various lenders, including the big banks, right? So when you're talking or working with a mortgage broker, he should be able to tell you, for example, what kind of rates you're getting from CIBC and also what kind of rates you're getting from BMO. They can actually create like a summary and tell you which are the best options for you and give you some recommendations that way. And how mortgage brokers get compensated is they actually get paid by commission, but this commission actually is paid by the lender or the banks, right? So as a buyer yourself, there's actually no cost to you. And that's why for my own property purchase, I actually prefer working with a mortgage broker. And the one that I work with, he's very knowledgeable and he can tell me the pros and cons of each lender. The second type of lender that you can work with for mortgage approval is your local banks or credit union. And generally speaking, the bigger the banks are, usually they can offer better or cheaper rates because their main clientele is the more credit-worthy people. And if you're someone who may not have the best credit, then there's also smaller banks that can still offer you a mortgage with easier approval, but usually they come with a higher interest rate as well. And that leads to our third lender, which is the alternative or the private lender. These are what we call the last resort kind of lenders, because usually when someone cannot qualify for a big bank or even for a smaller bank, then that's when we start looking for a private lender for them. And these are the lenders that are either individuals, right, or they're private businesses that lend out money for people to complete their home purchase. And so compared to the banks, they are actually a lot easier to qualify for, but they do come with a higher interest rate as well. So depending on your situation and what type of person you are, you might want to work with one or the other. For myself, I prefer to work with a mortgage broker because I can basically skip all the work, right, and all the shopping around, right? Somebody can do it for me. They can provide me with a summary, right, to give me some recommendations, and I can just decide very quickly and efficiently which bank to go with. Now, if you're someone who's more DIY or more hands-on, then you might want to go into each bank yourself, right, and try to negotiate a better rate that way. Now, the third big trap as a first-time home buyer, and I would say this is the biggest trap of all, is if you're only considering whether or not you qualify for the mortgage, but not considering the monthly payments that comes with it. Because something to know about qualifying for mortgages is there's actually one important factor that they look at, and it's something called a TDSR. And what it stands for is total debt service ratio. Now, what this number tells us is whether or not the monthly payment will be comfortable for us. And the formula is this, right? It's principal plus interest plus taxes plus condo fees plus utilities plus any other debts that you may have. And we take all that and we divide it by the annual gross income, then that will give us the TDSR number. So what the banks really look for is they want to make sure your TDSR is less than 44%, right? So what that means is, are you using less than 44% of your income to pay for your monthly bills? And if you are, then in theory, it should be affordable to you, and that's when they're comfortable with lending you the money. But here's the tricky part though. The TDSR calculation, what they really look at is the annual gross income. And to be specific, it's actually our income before taxes. Now, when we pay for our bills, we're actually using our after-tax income. And that's where it creates a huge problem for a lot of people, is because depending on your income, we're paying on average around 25% to the government for our income tax. So right away, a chunk of money is already taken away from our paycheck. So a lot of people, what they'll realize afterwards is that even though they qualify for a mortgage, they're actually not comfortable with the monthly payments. So it might not actually be affordable to them depending on their lifestyle. And that's why one thing I always go through with my clients when they want to buy a property is a housing budget. And this is something that you should definitely do one yourself as well if you're considering buying a property. Now on the screen here, this is the tool that I've created to go through with my clients. And basically what we do is the first step is we want to list out the types of debts or the line of credit that we have currently. And then the second step is we want to list out how much cash or investments that we could potentially use for our down payment, right? And thirdly is what's the purchase price for the home. Number 4 is how much of a down payment we want to put for our home purchase. In our example here, the purchase price is $800,000 and we're putting $160,000 of down payment. If we're putting less than 20% down, we are required to have CHMC mortgage insurance. Now, this mortgage insurance, it basically adds a monthly cost to your mortgage payment. So this tool, we've actually included that calculation as well. So once we put in the numbers, we will be able to know right away whether or not we need to pay for this mortgage insurance. And if we do, how much does that increase our cost by on a monthly basis? And next, what we want to look at is the regular mortgage. In here, what we need to see is what is the interest rate that we're getting, and based on that, what is our monthly payment, right? And that includes the principal plus interest. And we can see getting 80% mortgage or $640,000 of mortgage from the bank at 4.5% interest rate, then we're looking at about $3,600 of monthly payment. Usually in this step here, I would actually recommend you can add another 0.5 to 1% to the interest rate to see what that number will jump to. Because this is actually a contingency, right? To let you know that, hey, if the government decides to increase the interest rate, what would the number be looking like, right? And we can see if we add 1% interest rate, our monthly payment has jumped up by over $300. That might actually make a huge difference if your budget is quite tight. Next is if you have a different type of mortgage called the HELOC mortgage, then we want to enter it into here as well to see what the monthly payment would be, right? But basically, it'll tell us what's the monthly amount that we're expecting based on the regular mortgage plus the HELOC mortgage. And from then, we can assess how comfortable we are. Besides this mortgage amount, there's also other costs that we need to pay attention to as well. So for example, when we're buying a property, there are also other upfront costs as well. For example, there's home inspection, appraisal, lawyer fees, and also property transfer tax. For an $800,000 property, we're looking at about $16,000 of upfront cost. You need to take this into account to see, hey, does my savings have enough to put the down payment plus these upfront costs? If we're short or we're out of budget, right, then we may need to lower the purchase price for our home. And once we've taken care of the upfront cost, then how much can we really expect to pay after we own the property? This is where we look at other monthly costs, right? So for example, there's the home insurance, repairs and maintenance, property taxes, utilities, basically the ones that we've talked about in the TDSR we'll actually be seeing in here, right? But we want to look at these numbers as well, right? So in here, then we're expecting a total of $4,500. At this step, what you need to ask yourself is, am I comfortable paying $4,500 per month, right? Before food, before entertainment, before everything else. And it's just to purely keep my home. Usually how we can get our clients prepared for this is if you're already renting, right, and you're also saving up for a home, then what you can do is add up the amount of total rent that you're paying plus how much you're saving on a monthly basis for your home purchase. Add them together and see if that's already matching this monthly expense number. Right, so for example, if you're paying rent of, let's say, $2,000 and you're saving $1,500 on the side for your future home purchase, if we add these two together, it ends up being $3,500, right? So what we can see that we're actually $1,000 short, right? If we want to own a home and pay $4,500. Now it's you need to decide, hey, like, do I want to lower my home purchase price, right? Maybe look for a smaller home or look for a different area, maybe something that's further away so I can afford it and still keep my current lifestyle? Or do I want to start lowering or cutting off some of the spending that I'm doing in terms of my lifestyle? You want to gradually get yourself used to this $4,500. At one point, you should be able to save $2,500 into your down payment fund every month. Once you buy a property, then you can transfer over basically and start paying for these monthly expenses of owning a home. This will be a very smooth transition and you won't feel tight at all. And so these are the 3 big traps that you need to watch out for as a first-time home buyer. And I hope this video gives you a little more clarity and help you with your home purchase to make it smoother as well. If you like what we talked about today, please hit the like button and subscribe to my channel and share with a friend who are also considering buying a home. And of course, leave a comment below as well to let us know if you're already paying attention to these or if there's other things that you should also watch out for, right? So you can give some tips to other home buyers as well. Thanks again for watching and I'll see you in the next one.